In this video, we are going to talk about 10 high dividend stocks. So before starting this video, please like this video and subscribe to this channel for our future updates. Investors' favored dividend stocks. Wall Street's finest passive income source is dividends that exceed the market average. It's not enough to invest in high-yielding firms, much more must be examined. Prospective investors should examine the company's health, competitive edge, financial status, track record, and industry when evaluating high-yield dividend stocks. Number 10. Walker & Amp, Dunlop Incorporated. Walker & Amp, Dunlop originates, sells, and services loans. Walker & Amp, Dunlop specializes in multifamily and commercial real estate financing. The company's clients are predominantly U.S. property owners and developers. Walker & Amp, Dunlop is the top U.S. multifamily lender. Walker & Amp, Dunlop is the top multifamily lender in the country and one of the greatest dividend stocks to buy right now. Walker & Amp, Dunlop will benefit as loans mature and borrowers refinance. Walker & Amp, Dunlop appears capable of maintaining and expanding its 2.41% dividend payout. Walker & Amp, Dunlop shares have risen in 2022, bringing the company's high valuation closer to what investors want. The company is pricey. WD trades at a premium, but few have a higher dividend yield with more upside. Number 9. Chevron. Chevron finds, develops, markets, sells, and produces oil and gas upstream and downstream. As an industry leader, they have a $347 billion market cap and a 3.29% dividend yield. Many believe the oil business could lose ground to renewables. The narrative may be true, but the change will take decades, making oil and natural gas attractive in the meanwhile. Despite the shift toward renewables, oil and gas industry leaders should continue to generate excellent returns for shareholders. Chevron generates more cash than ever before. Chevron's revenues are rising thanks to lower operating costs, increased output, and efficient capital strategies. Great news for investors: oil prices don't need to rise to earn additional cash. The dividend looks safe. Chevron believes it can fund operations and pay dividends even if oil prices rise dramatically. Number 8. Abbott Laboratories. Abbott Laboratories discovers, develops, manufactures, and distributes healthcare products globally. Abbott Laboratories' share price has risen 179% in 5 years, making it one of the finest dividend stocks. Shares are 24% below their 52-week high. The reduction looks to be due to a shift from COVID-19 stocks to value equities in today's inflationary environment. The company seems fine, but individuals are giving up on it too quickly. Abbott Laboratories isn't a COVID-19 play. The company plans to invest $2.7 billion in R&Amp winking and laughing by 2022 to serve the world's aging population and capitalize on profitable tailwinds. Number 7. Brookfield Renewable Partners. Brookfield Renewable Partners is an arm of Brookfield Asset Management and a green corporation. Brookfield Renewable Partners owns and operates renewable energy infrastructure. Brookfield Renewable is expected to fill up the shortfall from fossil fuels. Brookfield's sustainable energy portfolio is one of the safest and most diverse. Brookfield Renewable Partners will likely become the green industry leader as the world moves away from carbon fuels. Brookfield Renewable Partners estimates FFO per unit to grow 10% by 2026. Development and acquisition will drive growth. Brookfield Renewable Partners may leverage Brookfield Asset Management's enormous purse to grow and meet the world's demand for sustainable energy. BEP is headed by seasoned leaders who have made investors pleased for decades. If they match expectations, BEP might be one of the best high-dividend stocks in 2022. Number 6. Enbridge Inc. Enbridge, a dividend aristocrat, needs no introduction. Enbridge has led the oil and gas sector for years in liquids pipelines, gas transmission and midstream, gas distribution and storage, renewable power generation, and energy services. Enbridge's move to green energy has hurt its market position. Enbridge's high-yield dividend looks stable. The company has reliable cash flow. Enbridge's revenue, 98%, derives from cost of service and long-term contracts with high-quality clients. Most of Enbridge's business partners have investment-grade credit ratings, so the company's revenue is as secure as anyone in any industry. That's crucial to note with such a high dividend yield. Enbridge's security makes it a top dividend stock for 2022. Number 5. Store Capital Corporation. Store Capital Corporation is a net lease REIT, sometimes compared to Realty Income Corporation. Both focus on net lease investment properties to boost investor dividends. Realty Income has acquired more than 6,500 properties in its 52-year history, while Store has assets in more than 2,500 U.S. properties. Store is cheaper and has more growth potential than its competitors. Store is well positioned for the reopening economy. Store could break out with further acquisitions after being restrained for too long. Store REIT looks good in an inflationary climate. Store might operate as a hedge and return cash to investors if the Fed raises rates in 2022. Store's dividend yield is 5.72%, high enough for many portfolios. The company's growth potential could make its dividend one of the finest to acquire right now. Number 4. Devon Energy. Devon Energy explores, develops, and produces oil, natural gas, and natural gas liquids in the U.S. Devon's 5,134 wells make it a key oil and gas supplier. Devon Energy is one of the finest dividend stocks despite oil and gas industry challenges. Devon Energy is a pioneer in oil and dividends. Devon introduced the oil and gas industry's first fixed plus variable dividend. Devon Energy promised investors a base dividend and variable dividend that could reach 50% of free cash flow, after accounting for the previously mentioned base dividend and capital expenses. Experts foresee a 10 to 15-year development window for today's main oil and gas prospects. In mature countries, demand will diminish, while growing markets will require oil and gas for years, if not decades. Devon's present share price appears like a bargain when you consider its growth and fixed and variable dividends. Forward thinking has devalued the oil and gas industry. More investors are investing in clean energy, shorting the oil and gas sector. Devon Energy may be hurt by the shift away from oil and gas. Devon Energy has one of the lowest price/earnings to growth (PG) ratios in the oil, gas and consumable fuels industry and trades at a discount to its peers. Devon Energy's price/earnings ratio is below average. Devon Energy's low PG and PE ratios reflect an appealing risk-reward profile and inexpensive share price. Number 3. Kinder Morgan Incorporated. Kinder Morgan is a key North American energy company. Kinder Morgan is a firm that transports natural gas, not creates or steals it. KMI owns and controls pipelines and terminals. Kinder Morgan owns 85,000 miles of pipelines and 152 ports. Kinder Morgan's share price has been depressed by the epidemic despite its oil and gas prominence. COVID-19 has slowed the energy industry for 2 years. While the S&P with ton sticking out 500 is up 90% since COVID-19, KMI's move was careless. KMI is breaking out despite its 2-year underperformance. Kinder Morgan predicted its full-year 2022 results before reporting its 2021 earnings. The prediction reminded investors why they invested in KMI: a strong balance sheet, better net income, and higher EBITDA. KMI felt so confident in the industry's tailwinds in 2022 that it boosted its dividend to $1.11 per share each year, giving it a dividend yield of 6.4%. Kinder Morgan is reliable in a volatile market. KMI looks like a safe transition investment as the globe moves away from oil and gas. KMI is well positioned for future low-carbon energy sources. KMI looks equipped to deliver continuous, reliable cash flow for shareholders. KMI is ready to become one of the highest-paying dividend companies in 2022 and beyond. Number 2. Caretrust REIT Incorporated. Caretrust owns, purchases, develops, and leases healthcare-related real estate. Caretrust specializes in nationwide skilled nursing and senior housing. Caretrust owns 191 net leased healthcare facilities and 3 senior living properties in 24 states. Caretrust, which led the healthcare REIT business before COVID-19, experienced many difficulties. Caretrust had to worry about collecting rentals while delinquent renters were protected and forgiven. CTRE is down while the S&P wink with tongue sticking out 500 is up 90.4% since March 2020. CTRE's share price has behind broader averages. The healthcare REIT appears undervalued. Caretrust appears to be an industry leader, trading at a discount relative to its peers. It's not the company's valuation that got it on the list, but its future potential. The U.S. population is aging quickly, and healthcare technology is supporting longer lifespans. The Motley Fool reports that by 2050, 22% of Americans will be 65 or older. Long-term trends indicate a growing demand for senior healthcare and nursing homes. Caretrust is well positioned to benefit from long-term trends, making it a top dividend investment for 2022. Early investors may benefit from long-term growth and a 6.01% dividend yield. Number 1. Abbvie. Abbvie develops, produces, and sells prescription pharmaceuticals for several therapies. As a worldwide pharmaceutical leader, it's on most investors' best dividend stocks lists. Abbvie has been on the best dividend stocks 2022 list for 50 years. Abbvie has raised its dividend for 49 consecutive years, making it one of the best income investments for 2022. The pharmaceutical company's past and prospects are both strong. Abbvie's sales grew 59% year-over-year last year. That's outstanding for a well-established corporation. Abbvie's pharma pipeline should enable years of dividend increases. Abbvie's business model is bigger, more diverse, and better positioned to raise its 3.78% dividend yield. Abbvie is among the finest high dividend stocks since it's a safe income company. What do you think of our video? Let me know in the comments section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.